The reason why I've actually stayed on Robinhood is they make it extremely easy to use margin, okay? I got approved a long time ago. I think I've been on the platform since 2015 or 2016, something crazy like that. And essentially, I've been using margin without getting charged for it. Now, you might be thinking, that's crazy. How do you use margin without getting charged for it? It actually depends on the strategy that you're using. Some strategies will allow you to use margin without actually having to pay any margin interest, because you're not actually having the stock and you're not actually having the shares in your account. So certain option strategies will actually not even charge you, which is why I've been saying I've been using margin for free. Essentially, it's cost me nothing. I use $500,000, and if I go to my account and I go to my Robinhood Gold, so I've been a member since 2021. Before I was using TD Ameritrade. So I have another TD Ameritrade account where I do some boring dividend investing, but I also do use margin. But you'll see right here that if I scroll down, I'm paying $5 a month, but I have no interest, absolutely none. And when I count up my position, which you will see right now, 1.464 and 602, this looks like I have $2 million. And Robinhood is actually not showing the full amount of margin that I have. The way you actually count that, and I'm going to do it a little bit manually right now, but you'll notice that I have so much money in margin that it's ridiculous, okay? So here's the thing. Here's how you actually count, because most brokerages won't actually allow you to know how much margin you're using. It's actually very confusing. And the reason for that is they're not on purpose trying to trick you. But the thing is, if you see right here, it says 67,000, okay? And if I go to American Airlines, you still see 67,000. But if I go to Trade American Airlines options, it says 33,000. So what's going on here is that there is a margin requirement. And actually, every stock is a little bit different. So if I go back to American Airlines, you can see here how there's an initial requirement of 50% and a maintenance requirement of 25%. Now 50 and 25 does vary. So if I go to Oatly, although I really like Oatly, it is a small cap company. And for that reason, it is actually considered to be more risky. Despite the implied volatility not being that much higher, it's really not. It's about the same actually as American Airlines. So in my opinion, this doesn't make sense. However, I do believe that this is decided based on rules and regulations. So not sure if it's the SEC or whoever it is. There are rules and regulations that brokerages have to follow. Hence why common question I get a lot is, how do I get level 3 option trading? And I always tell people, it actually just depends on the brokerage. They have their own algorithms. So you just want to be smart on how you do your application. I'll leave it at that, right? You get it. So check it out. There's a 100% initial requirement here. So this is going to give me much less margin capabilities. Whereas if I use SPY, I do believe SPY still has a 50% maintenance. Yes, it does. And that's totally fine. But what I'm trying to get at is this really does vary. It really just depends. So now with that being said, I just want to do a quick tally of how much I actually have, because I'm actually not sure. And I'm actually curious, how much do you think I'm using? I said 500K, but I'm not fully sure. So I'm going to do some rough math right now on screen. And you tell me, before I do this math, how much margin do you think I'm actually using as a percentage of my portfolio? All right, so as you type that, and of course, as you hit that like button, because it really helps me create more content like this, I'm doing my very best to be as transparent and as educational as possible, because I really care about your results. So leaving a like really helps me. And of course, subscribing with notification. But let's do some math, okay? So I'm gonna go right here, and I'm gonna go to my total equity. If you'll notice right now, there's 1.24 million in SPY, 159K here. So when I combine that, that's about 1.4 million, okay? And the rest is not too much, but let's just add 100K here. So that's about $1.5 million. Okay, so 1.5. This is another 6 grand. This is probably a few more thousand, but here we go. We have another 16 and 9,700. This is not that much. Let me just get to the big dog. Let me get to the position where it's gonna be clear that I'm using margin. And here it is. Here's a very clear position. I have 20 cells, QQQ 301. This right here is a $600,000 position, which already puts me at $2.1 million, okay? This position, this option itself is already proof that I'm using margin. I already have more invested, okay? But that's not it. I'm still using more, okay? So I still have another big position, I know, somewhere on SPY right there, okay? So 15 contracts times about 400 is another $600,000, okay? This is, maybe 500. So I just did the math, and it's actually $582,000. That already puts me at like 2.6 million. So I'm already at 2.6. And granted, I don't have that much more. I still have some more options that I'm using margin on, but I think overall the number is 2.7 million. And I only have an account of $2,066,000. And by the way, this year has gone phenomenally. I'm up $200,000, 10% in the past 3 months. So that's going really well. But 2.7 divided by 2 is essentially about 35% margin. So the safe amount of margin to use, in my opinion, is about 30%. Now, where did I learn this? So actually, I didn't really learn this from Goldman Sachs or my education. I was actually reading a research article by Yale economists that were basically saying that since markets go up over time, and especially every 10 to 15 years, the market is almost never down. Even if you pick a random rolling 15-year period throughout history, even the worst time, like 1929, when there was like a Great Depression, you are still up over 15 years. And for that reason, if you're not retiring in literally 1, 2, 3, or 4 years, and you have some time horizon, it is silly not to use margin because the market rises. In fact, the market is basically always going up. And I just wanted to pull up this image, just went online, right? And I went up to 120-year history of the market since 1896. As you can see, there are some really hard periods, of course. I mean, one time there's a 25-year recovery, which I guess contradicts the 15 years that I just talked about. But the thing is, this means that you never added another dollar. But if you did some dollar cost averaging, even if you put $50 a month, right? Something super small, you would average your cost a lot lower and you would break even a lot faster than 25 years. So even the worst period is likely less than 15 years if you were dollar cost averaging. And I am not factoring in also using options for hedging, which we're also going to talk about in this video. I'm not factoring in creating income with covered calls or selling puts to get in or dollar cost averaging. So the truth of the matter is, even in some of the worst times, like even during 2008, and by the way, I'm going back to 1929. This is literally 100 years ago. If you look at anything in the past 50 years, the longest recovery is literally just 6 years. And if you're dollar cost averaging using options to hedge, the true amount of time it is to recover is like 2 years or less. I mean, for me, I was investing very risky during 2020. I had a whole lot of Tesla. I was not following any safe risk management practices, and I was not following a lot of rules that I'm going to discuss in this video and that I teach my clients at the moment. I was just basically 100% Tesla, and it was kind of dumb. But at the same time, I did a lot of research and I was very confident that Tesla's going to rise. I mean, I was very certain on it and I was willing to take a risk, and I guess my risk paid off, okay? It was a little bit dumb, but also I did my research, and that's kind of the moment, that was a season that I was in my life. I wanted to be more risky. But even though I had a lot of Tesla, and during 2020, we obviously had, the pandemic and everything, we had a huge crash and my portfolio must have lost $250,000. In that same year, I actually made all of it back. It was incredibly easy because, well, the market recovered, and as soon as it shifted, I made so much money using options. So even if the market ends up pulling back, you can make it all back if you know what you're doing. All right, so we discussed that I'm using 35% margin, okay? But how do you manage margin? How do you, put it to work? Well, here's the thing. You want to pick high quality stocks to use margin with. That's pretty obvious. Now, my number one rule is I don't really buy options, and I'm certainly not going to buy options using margin. It's completely silly. So when you're buying options, you're essentially already making a leveraged bet because, well, check it out. Let's go to SPY as an example, okay? So trade SPY options. All right, so check it out. If I buy a call option, say that I go out 7 days, okay? A call option basically means that I get to own 100 shares and bet that it's going to rise, and I get to pay a fraction of the cost. So for example, if I bought 100 shares, this would be $41,500. Now, most people don't have this laying around, even if they're doing pretty well, even if they have a successful business, they're an older guy, 50, 60, and they have $1 million portfolio. They still might not have $41,000 just laying around. So option buying is very attractive, but the whole point is that it's already leveraged. So right now I can buy this option for $231 and I can essentially own 100 shares, which is $40,000 worth, okay? So with a small amount of money, I am controlling a large amount of shares. Now, I can lose a whole $231 here, the entire amount that I pay for this option, okay? So using margin to buy options is silly because it's already leveraged. Why would you use more leverage to be using more leverage? Okay, a lot of people ask me, do you like triple X leveraged ETFs? And my answer is no. I don't like using triple leverage ETFs. I don't think you need to use leverage to get rich, okay? But I do think that you can use margin safely to get rich. And the example that I give is if you have a business, say a pizza shop, okay, and you have a line out the door, 50 people, and you're making awesome pizza, Neapolitan or deep dish Chicago. I've never been to Chicago. One day I want to go. If you're from Chicago, maybe we can have some pizza. But, I also plan to visit New York. So if you're from New York, maybe we can also have some pizza. But let's just say you have a pizza shop and there's 50 people out the door and you only have one oven. You are crazy not to borrow more money from the bank. Let's say you're completely broke. Still crazy not to borrow money to open up a second oven. Come on now. You have a line out the door. So it is going to be a good move to borrow money, which is essentially margin. And what you're doing with real estate, if you don't own your house and you have a mortgage, you're also using margin. People use margin every day in their life. They just don't realize it. In business and real estate and mortgages, you are nuts not to take a loan and to open up a second oven so you can make more pizzas and serve more of your customers. And that's the same exact way that I see margin trading. If you can use margin to basically make more money safely, and you know that you're going to make that money, then of course you should use it. But you should not use it on buying strategies because buying strategies are already leveraged. And they are in fact super leveraged because you're only spending $231 to control 40 grand. And that's why there's a huge risk, and that's why people that buy options typically lose. I think 80% of option buyers lose, and all my clients come to me saying, I bought options, I had lots of success my first month, and my second month was a big loss, and I lost everything I made plus some more. And I'm not surprised. It's because it's basically a casino, and that's exactly what happens when you play blackjack. You might win a few hands, then you might lose a few hands, and then by the end of the night, you kind of realize, well, I lost more than I made. So what strategies am I using? Well, I am actually selling puts on margin. You probably already realized that because as you can see, I currently have American Airlines where I sold a put option at 13. I have Alibaba where I made $184. I sold the 87 put at the moment. Again, if you're watching this in the future, what I'm teaching you doesn't change. So you can watch this anytime in the future and still have the same benefit. Disney, I literally opened up a Disney position today in my Discord because I got a question about it. And Disney is not really profitable because the implied volatility is low. But guess what? Because I'm selling a put option out of the money on a safe stock using margin, it's free. So I don't really care if I make $35 on $9,000 because the $9,000 is free. It doesn't cost me anything. And the reason for that is because when I sell a put option, it's an obligation in my account, but it's actually not shares. So I don't have to pay any interest because all I'm holding is a put option that I've sold. It's an obligation. But at this point in time, it's not actually in my account. It's just an IOU or a contract that says, I will take your shares if those shares go down. So yes, I'm ready to buy them and I'm ready to buy them on margin. And sure, I will pay interest if I do get put the shares. However, that's where we're going to talk about rolling. But first of all, going back to Disney, it's very easy. It's a no-brainer. I'm selling something for $9,000. Yes, I'm only making $35, but if I know my chances of making that $35 is like literally 95%, and even if I do get put, I like this stock and I can start running the wheel strategy, which I recently made a video about. I'm going to link it in the description. Super important to know the wheel because I basically run the wheel using margin. But if I get put, not a big deal. I'm going to run the wheel strategy. But guess what? Usually I don't even get put because I'm using technical analysis to know where the stock would be cheap. Essentially, where is there support for the stock? If the stock goes to this level, it can happen, but it would be very unlikely. And if I'm at a risk to get assigned, I'm going to roll the position down. I'm going to roll away from the strike price and go back into my safe territory, okay? So, I'll show you what rolling looks like in just a moment, but I want to go through some more of my positions because I think you can just copy and do something similar. But of course, you want to fish for yourself. A lot of my students just look at my trades, they copy, they see what I'm doing, they mimic it, but I also do like when they tweak it and they say, hey, I want a little bit more risk, or hey, I want a little bit less risk. I love that. I love teaching people to be self-sufficient and independent. My goal is not to hook people for life and to make money on them. Yes, I like being a coach and I do make really, really good money, but I just love doing this and I like seeing people get results, because when I started getting results as an option trader and I finally got to leave the United States, not that US is bad, but I really wanted to see the world. I want to travel more. So for me, it's amazing because this is where I found my financial freedom. And just to show you, I have lots of puts, and that's actually my favorite strategy. Selling puts, if I do get put, I run the wheel and I do covered calls. This is my top strategy for using margins. So in that case, I guess not too much changes because I'm still using margin on the strategy that I'm running. But there is a special way that I'm using margin on specific stocks, okay? This is a strategy that you can basically put a couple $100 in, and a couple $100 can actually give you a couple $100.